So this is what I call the Holy Grail. Okay, if the company becomes wholly owned by an ESOP, and if the company is an S corporation, then it's going to generate a K-1 every year that is going to send to its shareholder, reporting all of the taxable income of the organization. Well, if that shareholder is a tax-exempt employee retirement trust, the ESOP, then there's no taxes to pay. So this only became possible beginning in 1996 under the Small Business Jobs Protection Act, where qualified retirement plans became eligible S-corp shareholders for the first time. Very soon after that, the ESOP community realized that they'd overlooked something, that qualified retirement plans with pass-through business income are subject to unrelated business income tax, which is an even worse tax than the corporate tax. It's taxed at individual and trust rates, 39.6% maximum rate. So in the Taxpayer Relief Act of 1997, we were able to get an exemption just for ESOPs, not for any other kind of retirement plan, but just for ESOPs, from unrelated business income tax. So at that point, that pass-through income that's reported on that K-1 to the ESOP shareholder is now tax exempt. Since 1998 was the effective date of that. So as you can probably imagine, there was some abusive transactions that ensued as a result of that. People thinking, we can have a for-profit business that is not paying taxes. Why don't we just set up an ESOP where the only covered employees are the former owner and his wife? And it's cute, right? Then everything goes into their IRA ultimately, and on a pre-tax basis. And so Congress in 2001, as part of EGTRA, killed that fly with a giant sledgehammer and said that will not happen, and it doesn't. Okay, the only S-corp ESOPs that are out there today that are legitimate, widely held, widely benefiting all of the employees. And we don't have any of those kind of tax evasion schemes going on anymore. And so, as a result, a decade later, a little more than a decade later, we have about 3,300 S corporation ESOPs nationwide. Most of them are 100% ESOP owned ESOPs, 738,000 employees, and about $62 billion in plan assets. And so I asked the question there, is it too good to be true? Sounds too good to be true. What I remind people, though, is that all of these corporate earnings will eventually be taxed. When the employees retire and they withdraw their funds from the ESOP, those are taxed at ordinary income rates, just like any qualified plan distribution from a 401k or a profit-sharing plan. So ultimately, everything's going to get taxed. It's just a massive deferral, right? For that 25, 35-year-old employee, he's going to enjoy a 30, 40-year tax deferral on all of that income. And another important point to make is that ESOPs, unlike 401ks, are entirely employer funded. There's no employee money going into this. It's employer contributions to this plan that finance it.